If you will be able to master the ICT macros, I'm gonna guarantee you will be able to make a fortune from using them, and I'm gonna tell you how. But first I'm gonna tell you what you're going to learn in this video. The first thing you're gonna go over is what are macros, so you know what they are and how they work. After that we're gonna go over why you should use them, and if you don't, why you're missing out on a lot of profit. Third point on the list is how most people use macros wrong, why it's wrong, and how to actually use them like banks and hedge funds use them. I will also give you guys my favorite macro indicator, so you will have them perfectly easy displayed on your chart. And the fifth and last point is how I utilize macros in my personal trading. Before we get on to the first part of the actual video, please consider leaving a like, comment and subscribe. It would really help the channel. Thank you. So first, what are macros? Macros are specific times of the day, and in these specific times the market tends to always have a volatility injection, meaning it makes a big move and starts to attack liquidity aggressively. For example, the screenshot of a macro shown on your screen. Now that we know what macros are, why should I use them, Bieber, you ask? The thing with normal trade entries without the use of macros is you will be stuck inside of a consolidation most of the times. You also notice when you enter a trade and the market keeps consolidating on an entry price, that's because you don't use macros. If you use macros in your trading, you don't have the problem of being stuck in a consolidation. The market will deliver straight to your target instead of the time range of a macro. It's far less likely that the market will consolidate inside of a macro. Let me show you this example right here. You have market open right here, going for the downside, going in the opposite direction of your bias, drawn liquidity, which would have been right here, these two equal highs. You get a move back. This candle represents momentum. You get a big down wick, but a big candle up. It's rejecting this level and it wants to go up. You get a fair value gap, you get a fair value gap entry, but you're not inside of a macro. So if you use that, you would have probably been stuck inside 10 minutes of consolidation. It's just a headache. Instead, what you want to do is use macros and enter. After you get the macro open, use the fair value gap again. You can also use the order block right here, which should support your down close candles. Market shouldn't close below this, so you enter off this. Let's just say you enter off this. Place your stop loss here and your target right here. That's an easy 2R in only, let's say in only 40 minutes instead of 24 minutes. That's where you should use macros. Now there are two types of macros. The first type is open to close macros. These macros are most commonly used. For these essentially you have a rule of thumb, which would be take the last minute of 1 hour and first 10 minutes of the next hour. Let me show you this. You have the transition from the 9 AM hour to the 10 AM hour. Let's just blend the end of the 10 too. You have this and you have this. The last 10 minutes of the 9 AM hour, which would be 9:50, you have right here, and the first 10 minutes of the 10 AM hour, which would be right here. These are the first 10 minutes and these are the last 10 minutes. You take that and that time range from 9:50 to 10:10. That would be your macro. This is your macro. In that time you expect the market to move. Let's go for the 11. You have the transition from the 10 AM hour to the 11 AM hour. You take the last 10 minutes of the 10 AM hour, 10:50, and you take the first 10 minutes of the 11 AM hour, 11:10. That's your time range for the macro. Let's just delete this and this. That's your time range for the macro. In that time range you expect the market to move. Alright, very good. Not only do you have these times, but you also have some special macros, which are the following. There's two special macros. You have the 13:10 to 13:40 macro. That's one special macro down. Okay, very good. It just works like all the other open to close macros. And you have the 15:15 to 15:45 macro. That's another open to close macro. They just work like all the others I just explained. Now the second type are open-end macros. It's not recommended to be in a trade by the time these macros start. These tend to be highly volatile and can cause slippage, so even when you use a stop loss, you can lose more than you planned. These open-end macros are: first, all medium to high impact news drivers, so 8:15 AM, 8:30 AM, 10 AM and sometimes 2 PM. The second open-end macro is 9:30 market open move. If you're skilled enough to tell the draw on liquidity, you can use these as a catapult for your active trades to reach the take profit level. Okay, let's get over how most people use macros wrong. So what most people tend to do when they want to trade macros is they wait for the macro to open, like we have here at 9:50, the 9:50 macro. They wait for a sweep on liquidity, which we have right here, and the draws to the downside. So if you wanted to trade to the downside, you would have taken that sweep and waited for a market structure shift, which we get right here. But the problem with that is you probably missed the whole move, because the first entry or the only entry you would get is at 10, or like this fair value gap at 10.3, but the move is already over. You just missed the move. You can go home. Your trade is done. You can't make more money now. That's why it's just not recommended to wait for the macro to open and let some kind of structure form. You want to be in the macro, you want to be in the market by the time the macro starts. It's like, why wait and hope that the market delivers your move that maybe happen? As SMC traders, we want to call the market. We don't want to trade with hope. We want to call the moves of the market. Okay, and what we want to do instead is we want to look at the market. We want to get our draw on liquidity, like we have here. I'm just gonna explain it to you right quick. We are basically in a market maker sell model. I can make a separate video on that. Just let me know if that would help you. There's no problem. Anyways, so you have that low, which is your only low to the downside. The market would probably not go for anything else, and so that would be your obvious target if you wanted to short trade. Plus the market is rejecting highs 1 time, 2 times, 3 times, and that is before the macro. If you were at the market at like, yeah, let's say 11:30 or with whatever, you would have probably waited for that macro at 11:50 to hit, and yeah, you would search for a trade in that macro. Like I can explain to you. you see that the market is rejecting highs, it's rejecting highs again, it's breaking lows. And what you want to do is you want to enter before the macro. Like you see that candle, we got that change in state of delivery after we broke that that open of that up close candle with that candle. So you could have basically just entered right off this open, put your stop somewhere right here, target here, easy 2R in just 1 hour. With 1 hour of doing nothing, you don't have any drawdown. It's basically only going down. So yeah. So in summary, what we're gonna do is we look for a draw on liquidity, obvious draw on liquidity like we have here. We ask ourselves if we are in a market maker buy or market maker sell model. And then just see what the market wants to do and enter before the macro, so the macro takes you to your target. If you want a separate video where I explain market maker buy models, market maker sell models, and draw on liquidity, just let me know. So now that we discussed how good traders actually utilize macros, we can talk about, in my opinion, the best macro indicator. My favorite macro indicator is the ICT algorithm macro tracker by 2degrees. Here's a screenshot. And let's go over my settings real quick. I have all the boxes at the top checked. I have this on black. Of course, we want to do it at on the chart, so you have them displayed like with your candles. And since I don't trade the London session on futures, I don't have these checked like up until 7:50 in the morning. But yeah, I trade the AM session, so I have them checked like from 7:50 to 14:10. If you would trade London session, you can of course check these, and also it's important to keep these 3 at the bottom checked. That's about the indicator. And for the last part of this video, I will show you, as promised, how I use macros in my personal trading. So my main model would go like this. I open my chart at about 9:15 and mark out every important or low resistance liquidity pool above and below the market, which would be this, in this example, this buy side, and we have this sell side. We wait for 9:30 to hit and sweep some form of liquidity in either direction of the market. It doesn't really matter. If we have clear pools like this on both sides, it really doesn't matter. So we wait for it to open. We clearly sweep the buy side liquidity. We wait for a market structure shift. We get that, and after the close below this, we have our market structure shift. We can look for a way to enter the market. Plus, we have a macro at 9:50, which would start right here. Alright, so we have the macro open here. So 1 minute before, that's where we look to get our entry. I don't need a fair value gap. I have enough confirmation and I have a good risk to reward at this trade, because if I enter right here, just off of this down close, we can set our stop somewhere about here. Our target, let's go for 2, would be enough. Yeah, you would just open. So, and here the macro opens, we immediately get a big move, strong move to the downside, and it just keeps on ripping. So we sweep that liquidity, but I'm not done yet. Now I'm done. That would be my trade. It was a duration of about 4 minutes, like nothing, and yeah, it just made it 2 hours. If you found this video helpful at all, feel free to let me know in the comments. Please like, and yeah, have a great day.